Okay, so this is part two for the Nadex binaries. I'm here with one of my clients, and let's get into it. We're going to talk about call spreads now, the pros and cons of using the call spreads. So right here, when you click on indice call spreads, you have the US 500, which I trade the ESs. Here are the times. You could see this one expired. There's one 8 to 4:15. If we come down here and click refresh, it should refresh them all because we saw the expired ones, but now it'll give us the newer ones. Okay. So let's look at the ones with an hour left, about 50 minutes. So from 10 a.m. till 12 p.m. Eastern time. And these, I will tell you, I don't like these at all. Okay. I don't like the 1 to 2 hour ones. I only like the 8 to 4:15 or the daily ones. And I'll tell you why. Because if you look at these, they're only $10 wide. Okay. So if you look, they're all $29.90 to $3,000. The problem with these, and because the market moves so low, they're just not even trading. Let's see if let's go to the 11 to 1. Okay. So here's the problem with these guys. We're at 61 1/4 right now. Well, if we do the 60 to the 71, okay, there's a premium built into these. So if I get long, we're at 61 1/4. If I want to get long, I have to risk $40. So by break even within a couple hours, I need this to be above, or this to be above 29.64 just to get break even. Okay, so now I can make $60 if we have a big run. If you think, hey, the lows are in, and I think we're going to go way above and start to make new highs. Okay, then it might be worth it. But here's the problem. Every dollar higher that this moves, this should move $10, correct? Okay, because if you think about from 62.4 to 63.4, the 4, if that goes to 5, right? That's $1. So if you look down here, 2964.0, if I go up 1, that adds $1. So from 64 to 65 would be $10. But the problem is if we move right now, because we're at 60, we're at the low end of the bracket. If we actually move $1 higher on the ES, we should make $10, correct? Yes. But because there's premium built into this, we're only going to make about $6. Okay, maybe not even that, maybe $5. Now, if we move 2 or 3, if we're at 66, then we'll be right around the money. Okay. Meaning halfway, and then we'll get about $9 or $10. But then as we keep going higher, how much we make goes back down again. So if we're at 68, okay, with this'll be at like 67.5 by 68.5. So we're not going to make as much money as it keeps going higher once it gets above the halfway mark. Okay, so like right now we'll make about we'll say if we move from 60 to 61, we'll make about $5, we'll say. Okay, on here, right? This would just move. We will only show a $5 profit. If we move 2 points, then we'll make about $5 on the first point, $6 on the second point. Does that make sense? Yes. And then once we get to 65 up here, right, on the ESs, then we'll make about $9 or whatever. But then when we start going above 65, every dollar move will start to go back down again because there's premium built into it. So for that reason, I don't like these 1 or 2 hour spreads because it's not true dollar for dollar move. Okay. Now, if you do, let's now look at the 8 a.m. to 4:15. Okay. If you look, and right now we're at 58. So let's try and find one that's in between. And this is probably the closest one we're going to see, 2940 to 2970. Okay, here, let's look at this one real quick. 2955 to 2985. Okay, well, we're at 29.59, but look at where there's about $4 of premium built into this. Because while we're at 29.59, the bid offer is 29.62.6 by 63.5. That makes sense? Okay, and if I come over here and I look at the contract that's kind of in between, we're in the middle, right? What's half of 2940 to 2970 is what, 55, right? 2955 would be the 50. Well, look at this. We're now, believe it or not, it's actually under, right? We're at 2960.75. But we're right about that par level, right? Dollar for dollar. So if we move up a point here, this should rise by about a point. That makes sense? Yes. So look, we're at 61 even right now, right? We're at 59.1 to 60 even. Let's see, we're now at 62. We're at 59.6 by 60. So it moved up about half a point on a $1 move, but there's still a little premium because there's still almost 5 hours left. And that's the problem. One of the problems with Nadex is in the morning, you have all that premium left. Time decay, we'll call it. But as we go later into the day, there's less time decay, and then these numbers become very true.
So the best time to place a trade is 9 in the morning?
Well, it's not I'd say at 9 in the morning, the problem is there's a lot of time decay left, right? So there's premium just like a regular option. If there's a week left in an option, well, you still have premium that you could be right but still lose money. Okay, but as we go later in the day, this number right here, the bid offer, will start to really match up with that because there's no time decay built into it. But you'll see that like 2 hours, maybe 3 hours. If that makes sense.
Yeah.
Okay, but like I said, if I think we're going to move 5 points higher right now, okay, this is where I come from for the way I like to trade these. I like to look for something for the spreads, like right here, 29.40 by 29.70. We're right in the middle of it, kind of. Not really, because if you think about it, there's 20 points to the downside and 10 points to the upside. And that's why you're seeing this number off by about a point from the ES price and this price too, is because this has the same problem as you start to go towards one edge or the other, is you start to make less and less for every $1 move. Like we just saw the $1 move, but this only moves $6 because we're 10 points away from here. That makes sense?
Yes.
Okay. Now, if we were at 29.55, then we would see about a dollar for dollar move for the next 2 points up or down, and then the point after that would be maybe a $9 move. The point after that would be an $8 move, and so on. So like in the perfect world, if we bought this right now, okay, at 29.60, and we just price moves all the way up to 29.70 right now, how much do you think you would be up on this contract with $100 maximum?
70. No, if you reach 29.70.
Correct. If the ES hits 29.70, which is the upper bracket,
yeah, you got the full profit.
Well, yeah, that's what you would think, right?
Yeah.
But here's the problem, right? Let's look at the 29. We don't have it. The problem is if this is trading at 70, okay, this will only trade probably 67, maybe 66 by 67. There's still going to be about three points worth of time decay in here. Okay, so like, remember when I showed you the 55?
Yes.
One, and remember we were right down here at 57, 58, and that was trading for like 63 by 64?
Mm-hmm.
Well, think about it. We just rallied 5 points, and this has only moved up $1 or $10. Or do you see why I don't like these?
Yeah, that's why, because sometimes when I was taking the spread, I know my strike price and I know the brackets, and the price will be in, but I'm still in rates, which I did not understand before, because I would say, but I'm already in the bracket, how come I'm not in profit? Or if I make a little profit, it's not what I expect, it's not what the ticket show about the maximum profit. It's just a tiny one that you get.
Correct. And it's because of your time decay. And also, now the good thing with this is you could buy this, right?
Mm-hmm.
And price could just reverse and go lower. Well, that's your max loss, right? But then it doesn't stop you out like the touch brackets. Meaning, if we go above or below, it doesn't hurt. So something like this trade that we could have bought for $63, right? Well, our risk was only 80, but if we're correct and we get a big move all the way back up to 85, we can make $220 with only $80 worth of risk. Okay, but again, we've already moved almost 5 or 6 points, and this is only up $20 because we were at the lower end of the bracket. And also we could have gone below, we could have hit 29.50 and we're not stopped out. We just would have a max loss of 80, right? Potential. But we have 4 hours and 49 minutes to be correct, and by maybe in 3 hours this thing might be trading 29.70 again, and then we would actually be up. Probably if we bought 63 and we're at 70, we'd be up about $50 or $60. Because as we go higher, it gets more in line. If that makes sense. Like if the middle of this, 55 to 85 is 25.70, well, we're at 70, this'll be about 70 again at the money, right?
Yes.
Or the mid price, and then everything gets readjusted and you're now making $10 up or down. But as we get to one side or the other of the bracket, those numbers start to deteriorate, like go lower, right? For every dollar move higher. So once we get to about 68, 69 over here, you'll start seeing a dollar for dollar move. But as we keep going beyond maybe 72, 3, 4, 5, we start making $9, $8, $7. So, but that's why I don't like this. Now, the only way I really like this is something like right here. Hey, I think we're going to make a $2 move or like a $5 move really quick to the downside. Then I would probably look to short. Okay. I only have a $93 loss, but I know if we drop $5 and get back to the middle of here, I'll make about $40. Because remember, every dollar lower from where we're at, we're getting away from here and closer to the mid price of 55. 29.55 would be the mid price of 40 and 70, right? So as we start going closer, I'm going to make $8 for every point. The next point will be $9. The next point will be $10. Next point will be 10. Okay, now I'm up $38 or $40 off a $5 move.
I see. So that's why a lot of people say that when you want to take a spread contract, a lot of people, some they take at the money, but with a lot of contracts. So after maybe 5 or 30 minutes, they are out already with the profit. So they don't stay for long term in the contract. So in the trade. So after 30 minutes, they can take the profit and go with it. So this has to do also the timing when you enter the market, because sometimes I realize like if I enter, I don't know, sooner, or maybe I don't know if I was lucky, if I enter and then the market start to rally up or down, I start making already, I'm already in the profit. So after 5 minutes, I'm already in the profit and I can take my profit and leave the trade. But some days I can enter the market, but it takes long time for me to be in the green.
Yeah, it will with the spreads. Now remember, you should always have a plan, right? Mm-hmm. Where I'm entering, where my target is, and where my potential stop loss is. With Nadex, you don't need to worry so much with the stop, but with the spreads, right? I would still have a stop, meaning, hey, if I want to get short, okay, let me get short here. But I might go, hey, if it breaks above 29.65, get me all out, and then I'll take my loss. But the problem is, because of the spread, you're losing $10 in, you're losing $10 out, right? It's almost like, well, why not just keep time or make a better trade, or don't trade this product alone. And I'll show you why I like touch brackets better than these doing the same thing, because there's no premium built into it. If that makes sense.
Yeah, I see.
Okay. So now let's look at this real quick. We're at 29.64. Well, if I want to buy the 29.70 to 3,000, look how much of just the 29.70 is. I need to pay $29.73.60, which is a $36 loss. So my break even at 415 is 29.73.6. I'm paying $36 worth of premium of time decay premium. But with that being said, if you think we're going to have a huge rally for the next 5 hours, like right here, we have divergence, right? Very clear divergence. This might be a good trade, saying, hey, I actually think we're going to have a big rally going into the close of 20 or 30 points. Well, then that $36 might be well worth the risk reward, because if we rally all the way back up to the 29.90 level, okay, you could make about $150, give or take, off of a $36 trade. But if you don't get that big rally, or even if we rally to 75, okay, maybe you're up $10 or something. So, but again, this is if you need a big move. So those are the pros and cons of trading these things. And like I said, just because you have a small loss doesn't mean it's a good trade like this, right? Because there's so much time decay built into it. Also, I like the binaries because I could take a $25 trade and not have to worry about anything. If that makes sense.
Yeah, I see.
Right? Like, I don't need to worry about getting stopped down. I don't need to worry about point spread. Remember, that $1 spread, right?
Mm-hmm.
Well, you need 2 points or 2.5 points just to break even on this trade. So if you're trying to scalp or you're only looking for quick little moves, it's not worth it.
Yeah.
Okay? Because your $10 spread in, $10 out, that's almost like paying a $20 commission.
Oh.
So for me, that's why I stay away from this product.
Mm-hmm.
So, any questions on this one?
No, it's okay. Now it's more clear to me, because most of the time when I was trying to take a spread, I have to look for the price, where the price is, and then I look for the spread. If I know that it will go higher, then I look the price that is close to the floor. If I'm gonna long it, then I'm gonna look also if my maximum loss is way low. Then I will take a trade. But for some reason, I will be in the trade for 1 hour, 2 hours, and it's not really moving, because I noticed by observing the ES, it does not make a lot of big moves unless there is a a news. So most of the time it's just up and down, with respect to the Fibonacci levels.
Yeah, and like I said, it's kind of like the fibs. Like you might look at this over here, right? These red lines are the first hour high and low, Fibonacci's, right? And you have the 38 and 61%. Okay, and this is where we were talking about the scaling earlier. Maybe you go, hey, if we come down here, let me get long here. But again, I wouldn't get long these guys. Okay, and I'll transition into the touch brackets now. This is where I would either trade the touch brackets or I would trade the binaries. Okay, because I could control and manage risk in a whole different way. Now, one thing with the touch brackets that you need to really understand is so like right here we'll use this touch bracket here. Okay, with the spreads, price could go above or below. So if you look at the chart, okay, we'll say this is a 10-point spread, right? It's probably not 10 points. Hold on. So let's say these yellow lines are the call spreads, okay? And well, price could go below. Price could go below that price and then reverse, and the bracket is still valid. Okay, because it's based off of time. Okay, like they have the call spreads have an expiration on their brackets. Okay, of time, not if price touches and goes through it. When you deal with touch brackets, they're a little different. So they're good for the entire week, or like they start, I believe, Monday, and they're good until one of two things happen. Either they expire in 3 days, right, on Friday, or until price breaches that bracket by literally 1 penny. Okay. So let's kind of look at this as an example. This is a 2944 touch bracket, and let me draw a line right here for you, okay? So this white line, and the upper end is 94. Right here. Okay, so this is what the touch bracket is. So this thing's either going to expire on Friday at the close, or when one or the other end of this gets breached by 1 penny. Meaning, if we print 29.43.95 or 75 or whatever, or like 0.90. 43.90, it expires. Okay, and you take and that's where you take a full loss. Now it's not like with the call spread where you're still in the trade. It might go back up or whatever. Here, it's done, and you take your maximum loss. But here's the great part about touch brackets. Look at price, right? It's literally right there at price. And look at your spread. Your spread's only we'll say $3 to $4 wide. I'm sorry. So by having a 3 or 4, well, remember the call spreads were $10 wide, right?
Yes.
Well, these are only $4. So to get in and out, you're only looking at $7 or $8 worth of spread. Okay, like $3, which is essentially a tick to half a tick worth of commission, if you want to call it. Now, remember, commission, I believe, is $1 in, $1 out, but because of the spread, kind of like if I buy the ES at 61, by 61 and a quarter, I'm losing $12.50 just off that spread. Here, you're losing $3 or $4. Does that make sense?
Yes.
Okay. Or another way is stock, if you buy Apple for $110 or $210.25, but the ask is a $210.35. Well, there's a 10-cent spread. So the minute you buy, you're already down 10 cents. So with that being said, there's no time decay in these guys. So let's look at, right now we're at 29.60, right? Let's try and find something that's very similar right here. Let's look at the 54 to 3,000. Remember how we looked at the one that was only a couple points away and there was like $3 or $4 of time decay?
Mm-hmm.
There's no time decay in these things. It doesn't matter if you're in the middle or if you're at the low end of it. Okay? And that's kind of the thing I really like about this. Now, there are times where, and this is a perfect example. Think about this. We have our lower 61.8% Fibonacci from the first hour high and low, right?
Yes.
Essentially at 44.75. This lower bracket is at 44. We could look to do something like this, 29.45, and look at what our risk reward is. Because this is what we hope to happen. It comes, it fills us, and then it bounces, but it never breaches 44 on the bid ask. Now, you're really threading a needle, a needle, right? It's essentially like me doing something like this. Saying, I'm going to front run this and give it 2 ticks worth of risk. And hopefully it comes down, fills you, and then that's the low. Does that make sense? Okay. Now, maybe you hit a home run and it reverses and we go all the way back up off that low. Or maybe it dips right below. The problem is if it dips right below and then reverses, guess what? You get stopped out and the bracket disappears and you lose your whole $10.
Yeah.
It's a problem, right?
Yeah, I see.
So,
but if you bounce from the 29.45, then you lose.
Correct. Now you might sit there and say, hey, let me buy the 47 because maybe we'll front run this and maybe price will go do something like this. Maybe we'll come down to price will come down, right, to 47 and then rally back up to 57. Well, if we buy at 47, now we're risking $30, but if we rally back to 57, which would be this low right here, right, that we found support, bounce, reverse. If we came to 47 And let's say that 47 was a major support level. Okay. Well, we still have a little bit of a leash of 3 points, right? So it comes down, it fills us, and we bounce to 57. Well, we just made $30 worth of risk, but we made $100 of profit. Does that make sense?
Yes.
Okay. So I just want to make sure it's all kind of tying in. Now, here's another way to trade this. Let's say right here we have divergence again, correct? So we have, let me draw it real quick. So now we have huge divergence, right? But then from here to here is divergence. Here to here is divergence, right? Now, it's not done playing out, but I would be looking for price to break above its previous candle with a divergence. So right now we're in what I call a waterfall, right? If you go look at my videos, you'll see the waterfall. This is a perfect waterfall where on the downside we have lower highs, right? I want confirmation. I'm not trying to low tick the thing, but I do want confirmation that we break above a previous candle with this divergence, because this could still keep going lower, right? But if, let's say, this candle breaches this by 1 or 2 ticks, that confirms we're now in an uptrend on a 5-minute chart, because that's what we're looking at, right? So if you think about this, we have a waterfall here. 1, 2, 3, 4, 5, 6, 7, 8, 9. The minute this breaches, we're in an uptrend. What does price do? It goes higher, right? Here, on the way up, as price rises, we look at the lows, right, for the waterfall. So we have 1, 2, 3. This candle breached below, right? So this is called a reverse waterfall. The minute it breaches, we're in a downtrend. And what does price do? Goes down, right? So for me, the way I would trade the touch brackets is, hey, when price breaks above, and maybe I see the divergence, right? Maybe we bounced off a support level, whatever. But right now we have about 2 minutes left in this candle. Okay, right now I'm watching this because this candle's still active. But if this candle closes and we have a new candle, then I'm watching the high of this at 50. I want to see a 60 print, right? A 29.60 print, because the high is 29.59.75, right? So see how if I would have jumped in early, now I'm wrong. I want confirmation. Okay, but let's say we get that confirmation on the next candle. Okay, and let's just draw a candle, and let's say we break above by 1 tick, right? I'll come over here and I'll find, probably looking at my entry 60 and the low here is a 56, right? I wouldn't use this bigger contract, because look at, if I enter at, we'll say 60.5, right? Because of the spread, right? Well, I'm risking $165. Now, the cool thing is I only have to put up available cash of $165 to take this trade. Now, every $1 move here is 1 point here, but every one full dollar from 55 to 56 is $10. This is the equivalent of me trading 100 shares of SPY. But guess what? I get around the day trading rule of the SEC because these are Nadex is regulated by the NFA, National Futures Association, so there's no day trading rule that I have to follow. And I only need to have $165 of capital. Okay? But I don't like this contract. I would rather trade this contract here. Because the low here is 29.44. Well, I know the low here was that 56 level, right?
Yes.
Well, I would rather trade this with a touch bracket of 54, if that makes sense, right?
Yes.
And let's put this at 60.5. Well, look at what my risk is now. And the reason I do this is the most I could lose is $65. Okay? Here, I have to, the most I could lose is $165. Well, I get it. You could do either or, but here's the thing. What if it goes up and then all of a sudden a news report comes out? Okay? And it just drops the market 20 points in the blink of an eye. Well, here I got to take a $165 loss. Here, worst case is I lose 65, and I only have to use $65 of capital, which I would rather do. Now, think about this trade. Maybe we want to get long right here. Okay? Because we look where the low was, 55, right? Well, look at the risk reward. I could get long at 56.20. I'm only risking $22. If we, and essentially price has to stop or go below this white line before I lose $22. That makes sense?
Yes.
So if we could get a nice rally from here, okay, I just made a home run with only $22 of risk, but the problem with this is you're threading the needle, right?
Yes.
And this might be something where you go, hey, I think we're getting bounce, but let me trade the binaries. Maybe I'll buy the 63 for us to get all the way back up here on the binary side. And let's see how much that binary would be now. So maybe the 67?
67. 61.
Or we could do 61, but here I'm putting up $24 and now I'm not going to make as much, but I don't have to worry about the market going up and down real quick, right? To kind of fall, break below, and then reverse. I always have a joke that I say, I trust the market like I trust a woman, right? I don't trust them. No offense to any women listening, but it's one of those things where I see it all the time where they'll do a head fake below, stop you out, and then reverse. And it's not coming after you, right? It's just where our stop losses or these numbers, okay? These numbers aren't random. Okay, this is another thing that I'll kind of give you a little insight. These are not just random numbers that they pick. Okay, these numbers are very calculated because we should not break below 54 because it's a support level. What it's based off of, I have no clue, but look at this 94 level, right?
Yes.
Well, what's the high of today?
95.
Or from this whole move?
Yeah, it was
94.
94, yes.
If we get back up there, do you think we're going to blow right through it? No, we'll probably make a lower high, right? And that might be a great short trade. Maybe go short in 93 if we went from here all the way back up here really quick. Yeah, short 93 for a couple points. Okay. Now, the other way I would look to trade something like this, okay, is let's say I'm bullish right now. Maybe I'll use this. I'll get long on this contract right here. Okay. Yes, I have to put up $116. That's my max loss, but that's not where I'm putting my stop loss. Okay. What I'm doing is I'm saying, let me get long here. Okay. And my stop loss is at 53. I'm only going to have a 2-point stop loss on this, we'll say, right? So I might get long at 55 even or whatever. Okay. And then once I get filled and it goes into my working orders, I'll put an order in to sell that contract at 93 or 92. So I'm only risking $30. Okay. But I'm not going to have to worry about getting stopped out on the bracket. Meaning, if I traded the other bracket, if I actually traded the touch bracket of this 54, let me move this back over. If I trade this 54 touch bracket, okay, well, I could get stopped out. Yes, I was only risking $23 or $22, right? But price might go like this, just really quick. Price might go, ooh, I get filled. It goes to 53. 50 and then it bounces. Okay. Well, here by going the 44, I have way down here, but I know my stop loss is at 53. So I'm now using a correct stop loss, but I don't have to worry about the touch bracket getting touched and expiring and then I get stopped out. I want to say my stop is X number. And that's where the touch brackets come because there's no time decay involved in them. Any questions on that?
No, I really got a lot of information today that I need to process. So for the spread, binary, and touch bracket. And I really appreciate it. It's very, very important from the information that you gave me. Now, maybe.
Oh, I'm sorry. Hold on 1 second. I'm going to end the video here. Okay, for Nadex. And I hope you guys enjoyed the video.